Welcome to vTalkInsight, Market Drivers Daily for April 14th, 2026. Oil supply shocks and an equity rally are pulling in opposite directions today, as geopolitical risks, supply chain strains, and powerful earnings beats all compete to set the tone for the next leg of this cycle. Geopolitics and energy still anchor the macro backdrop, but the signals from prices are increasingly conflicted. In the Strait of Hormuz, tanker traffic has collapsed from normal flows in the hundreds of vessels per day to only a handful, as a U.S. blockade and Iranian countermeasures keep the choke point effectively shut. With no durable deal in place, the working assumption is that this disruption could run for days or even weeks, keeping global energy supply on a far tighter leash than headline futures suggest. On the diplomatic side, the United States and Iran are testing paths to renewed talks, with potential meetings in places such as Islamabad or Geneva and some softening of U.S. nuclear demands. Yet expectations for a real breakthrough remain low, because both sides are still focused on domestic politics and regional posture, and additional actors like Israel and Lebanon add further escalation risk. The International Energy Agency is already flagging this conflict as a major global energy security threat, even as it projects that oil demand could contract this year for the first time since 2020, driven by demand destruction in developed economies and parts of Asia. Physical oil flows tell a much tighter story than futures curves do. Exports from key Gulf producers are severely constrained, with tens of millions of barrels per day effectively stranded by damaged facilities and blocked shipping lanes, while OPEC output has dropped sharply, led by Iraq, Saudi Arabia, and the UAE. At the same time, front-end crude prices have retreated below $100 after an earlier 8% spike, and the curve sits in steep backwardation, with triple-digit spot prices but lower levels further out, signaling that markets still see this as a temporary shock. Compared with yesterday, when futures snapped back above $100 and physical barrels into Asia and Europe traded closer to $140, today looks more relaxed as hopes for renewed talks take hold. European bond yields are a touch lower, with Italian and French 10-year yields down around 5 to 6 basis points, and the U.S. 10-year Treasury has slipped by almost 2 basis points, pointing to incremental safe haven demand but not outright stress. Global institutions such as the IMF and World Bank are trimming growth forecasts by about 0.3 percentage points on the back of the energy shock, while the euro area is now expected to grow only 0.9% with inflation around 2.6%, underscoring a mild but rising stagflation risk. Equity markets, however, remain impressively resilient. The S&P 500 is trading within 1.5% of all-time highs. The Nasdaq has logged a 9-day winning streak, and major European indices are rallying on renewed optimism around a ceasefire and potential U.S. Iran negotiations. Energy has been the top-performing S&P sector year-to-date, although recent oil price declines have erased some gains, and large asset managers and banks report turning overweight U.S. equities, treating geopolitical volatility as a chance to add risk rather than de-risk. That optimism rests on two ideas: that real energy prices remain below their 2022 peaks, and that strong earnings in a still solid U.S. labor market, with unemployment around 4.3%, can absorb temporary cost spikes. The risk is that if oil were to hold closer to $150 for an extended period, estimates suggest it could add nearly 1 percentage point to inflation over time, with knock-on effects for food, manufacturing inputs, and bond yields. Heading into the April 21st ceasefire deadline, the key watch points are whether Hormuz shipping normalizes, whether disruption spills into the Red Sea and Saudi exports, and whether the current gap between tight physical supply and relaxed futures pricing starts to close. The same geopolitical tensions are now morphing from a pure price shock into tangible supply shortages across global trade routes. Daily ship passages through key Middle Eastern corridors have fallen from roughly 150 to as few as 5 to 10, as blockades and insurance constraints deter vessels from transiting the Strait of Hormuz and parts of the Red Sea. Freight rates and vessel fuel costs have surged, with bunker prices roughly doubling over the past 6 weeks, and some ships idling as owners await clearer guidance on security conditions and insurance coverage. The result is a cascading shock across multiple supply chains. Flows of oil, liquefied natural gas, fertilizers, and metals have all been disrupted, and the International Energy Agency warns that no country is fully insulated if Middle East tensions persist. Normalization will not be instantaneous even after a truce. Estimates suggest it could take up to 4.5 months for shipping patterns to recover once blockades are lifted, while repairs to damaged refineries and pipelines could stretch over years. Industrial metals are a clear pressure point. Middle East disruptions have removed around 4% of global aluminum production, pushing the market into a projected 2 million ton deficit and doubling European physical premiums from about $300 to $600 per ton. Europe is particularly exposed, relying on the region for roughly 30% of its aluminum imports after reductions in Russian supply, and alternative production is constrained by electricity shortages and capacity caps in major producers such as China and Indonesia. Backwardation in both aluminum and oil futures curves, alongside declining warehouse stocks, underlines the acute near-term tightness, while copper prices are forecast to stay well above the $10,000 incentive level, supported by expected government stockpiling and limited new supply. Beyond commodities, the disruption is feeding into broader inflation risk. Rising input costs for plastics, ethylene, aluminum, and copper, combined with higher freight and insurance, point toward renewed margin pressure for manufacturers and potentially higher prices for end consumers. There are already reports of diesel shortages in Australia and reduced manufacturing activity in parts of Asia, and persistent congestion at ports like Singapore, Shanghai, Korea, and Japan raises the risk of spillovers into trans-Pacific trade. Central banks are alert to this backdrop. The European Central Bank describes the euro area outlook as lying somewhere between its baseline and adverse scenarios, urges that any fiscal support be targeted and temporary, and remains committed to a 2% inflation objective despite the energy shock and growth headwinds. Not everyone sees this as a structural break, though. Some participants expect freight rates to fall sharply once disruptions ease, as reduced Middle East volumes are partly offset by longer haul routes elsewhere, and overall demand for ships normalizes. The anticipated impact on food prices, for example, is seen as significant but likely less extreme than during the COVID era, even though both processed and unprocessed food chains will feel the strain. At the same time, new pipelines in Saudi Arabia and the UAE that bypass Hormuz are gradually reducing Iran's leverage over energy flows, and recent crises are accelerating a broader rewiring of supply chains that could permanently redirect some cargo away from the most vulnerable choke points. Against that backdrop, close attention is likely to remain on shipping conditions through Hormuz and the Red Sea, port congestion in Asia, trends in vessel fuel and freight costs, and how quickly these pressures show up in corporate earnings guidance, which is where we turn next. While geopolitics and supply chains dominate the macro narrative, earnings season is providing an important counterweight for risk assets. Across major banks, energy companies, and technology leaders, results so far have generally beaten expectations, helping equities absorb higher energy prices and volatile rates, even as the quality of guidance becomes more critical. JP Morgan set the tone with a very strong quarter. Earnings per share of $5.94, revenue of $50.5 billion, and net income up 13% to $16.5 billion, underpinned by a 21% jump in fixed income trading and 17% growth in equities. Advisory fees surged 82% year-on-year, and overall trading revenue rose about 20% to a record, echoing broader strength in capital markets activity, also highlighted by Goldman Sachs and Citigroup. Even so, JP Morgan's shares fell roughly 2.5% after the bank trimmed its net interest income guidance, underscoring that investors are now laser-focused on future profitability rather than backward-looking beats. Citigroup delivered its strongest quarter since the financial crisis, reporting its highest revenue in a decade, driven by $5.2 billion in fixed income sales, record equity trading revenue of about $2.1 billion, and returns on tangible equity around 13.5%, comfortably above its annual target. The bank has completed roughly 90% of its restructuring and regulatory fixes, positioning it to pivot from turnaround mode toward growth, and its stock has doubled over the past year. BlackRock also reported exceptional earnings, supported by around $744 billion of net inflows over the past year and continued dominance in exchange-traded funds and retirement asset management. At the same time, Goldman Sachs' record equities trading revenue contrasted with a notable miss in fixed income, raising questions about how durable the current trading boom will be across the peer group. Sector-wise, earnings growth is highly concentrated. In the United States, profits in the tech sector are expected to rise by around 40% year-on-year and to account for roughly 90% of S&P 500 earnings, even as valuations have compressed from earlier peaks. Energy, materials, and technology together are driving the bulk of full-year earnings growth, with energy showing the largest positive surprise thanks to higher oil prices and trading volatility. Companies like BP and Shell anticipate exceptional first-quarter oil trading results, while refining margins are expected to stay robust because global capacity is tight, even if Middle East tensions ease. The flip side is concentration risk. Tech growth is dominated by a small number of stocks, and financials remain the weakest S&P sector year to date despite strong trading income, reflecting ongoing concerns about net interest margins and valuation. Outside the headline winners, the picture is more nuanced. Publicis has delivered resilient first-quarter earnings and reaffirmed full-year guidance despite war-related confidence shocks. And companies such as Poste Italiane have offset higher fuel costs with prior hedging of gas and electricity, even as they book sizable capital gains on stakes like Telecom Italia. Luxury is more mixed. LVMH has reported a 50% drop in Middle East sales, far worse than expected, while still seeing early signs of recovery in China. Rolls-Royce and Tapestry, by contrast, note strong global demand and limited direct financial exposure to the region. Across sectors, corporate margin compression remains a key risk if firms cannot fully pass through higher energy and input costs, and forward earnings estimates have started to drift lower, with revision indices for major brokers turning negative. Even so, many assessments still see U.S. equities as moderately attractive, with expectations for a sixth consecutive quarter of double-digit earnings growth and confidence that robust corporate profits can buffer short-term macro shocks. The next phase of earnings, particularly for energy-intensive industries, airlines, and second-tier banks, will be critical in testing whether that optimism can coexist with ongoing supply chain disruption and elevated geopolitical risk. Across geopolitics, supply chains, and earnings, the common thread today is a market that is leaning toward a contained shock, even as physical oil flows, shipping bottlenecks, and margin risks argue for a higher and more persistent risk premium. Key watch points from here are the April ceasefire deadline and Hormuz transit data, the evolution of freight and metals prices as supply chains adjust, and how the next wave of earnings guidance balances strong current profits against rising input costs. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.